you all so much for coming and for sticking around through the afternoon. We are going to talk about global challenges and the European outlook, and I have a really great panel for you. I've got Sean Berrigan, the Director General for Financial Stability and Capital Markets Union from the European Commission, Koenraad Debackere, the Chairman of KBC Group, and then Peter Praet, former Chief Economist and member of the Executive Board at the European Central Bank. We have only 25 minutes, so I'm going to keep my introduction short and let Sean set the stage for you about where we stand and what the challenges are.
Okay, well, I mean, this is a particular moment in the life cycle of the Commission. So we are transitioning from one mandate to another mandate. So people keep asking me what I'm going to do in the next mandate, and I can't say. So I then talk about context. So I'm probably the right guy to have on this part. And the device I've been using is to just compare the context that applied in 2020 when this mandate started with the context that applies now. And what you see is there's a sort of dramatic transformation has taken place. I mean, we're in a very different place than we were 5 years ago. And I can just identify a few of these which would be of relevance to me, and therefore, I suppose, by extension, are relevant to the bond market. The first, of course, is the geopolitical transformation. So Russia's war in Ukraine, I think, has brought about a sort of rethinking of globalization, which was essentially economics driven. And suddenly we realized it doesn't fit so well with the political realities. And so there's a certain rethinking going on, which can be both positive, but can also be negative and can create a lot of uncertainty around the economic future. So that is one source of problems. I think already there had been a rethinking of globalization linked to COVID and the lockdown. And that was another inconsistency we discovered in globalization. Again, it was an efficiency-driven process, but there was probably not enough attention being paid to the security of supply. So we ended up, as we might expect from an economic process, with a concentration of supply in certain places, and those supply chains broke. So I think these two things, from an external point of view, are dramatically different now. The geopolitics are different, and the whole thinking around globalization are different as we go into this mandate. The other two things which are different, and I'll mention because they're relevant to the Commission, is the Green Deal. The politics around the Green Deal are now much more complicated than they were in 2020. In 2020, it was difficult to find anybody who didn't believe that the Green Deal was a great thing and that we should leave the world a better place for our children, etc. There was less discussion of the costs. And over the 5 years, the costs, the short-term transition costs, let's say, of greening the economy have crystallized. And that means that in the next 5 years, we're going to have, I think, a much more complex debate around green. And then lastly, the digital transition, which I expected to be a rather wonky thing. People would be talking about it, but the public would not be very interested. Well, actually, the public are very interested in digitalization because it is creating kind of societal implications. So privacy has become a matter of issue. Fraud, financial crime has become a matter of issue. And of course, then there's the economic part of that, the disruption, disintermediation, which has also become a focus. So again, in the next mandate, I think the digital agenda and the digital finance agenda will be surprisingly political. And the digital euro is a good example of that, where again, there's a lot of politics around the digital euro. What does that mean for me, and therefore, by extension, I suppose, to the financial system? Well, one, it means that economic security will loom large in the discussion. And there, the issue is going to be how we will balance economic security, whatever we mean by that, against remaining open. I mean, as financial people, we know you can secure your supply chain by diversifying, and that's the way to go. But others see economic security more about onshoring and closing, and that's going to be an important debate in the next few years. I think the other thing is that competitiveness will jump up the agenda. It's already there. We've had a raft of reports discussing on competitiveness. We wait Mario Draghi's report on competitiveness. And there, I mean, it's quite simple. I mean, how the financial sector fits in there. I mean, access to finance is a part of competitiveness, let's be honest. Access to the appropriate finance at the appropriate terms. And if you were like me, you were trained in neoclassical economics, you know that this is fundamental equation. Growth is a function of productivity and thrift. There's nothing wrong with Europe from the savings point of view, but there's a lot wrong with Europe from the productivity point of view. And that seems to suggest that there's something wrong with the intermediation of savings to investment. And that's where the financial system comes in. So you will be front and center of the competitiveness discussion over the next 5 years. On green, we will continue to do sustainable finance, but we'll have to be a bit more balanced in terms of completing it, but also making it more usable. And there we'll have to look at things like transition. We'll have to look at just the usability of the framework, because we've put it in place very quickly, but we know already there are some things we need to change. And digital, well, that's a complex agenda. It moves very fast. We're always behind anyway in regulation, but in digital space, we can get very far behind. If you look at MiCA, for example, we put in some stuff about decentralized finance and NFTs, but actually they're kind of patches, if I may use the phrase, because they weren't, DeFi and NFTs weren't there when we launched that proposal. But they come in the middle of the proposal. So similarly with AI, we have to think what we will do with AI, but that's really fast moving. So how do we manage it from a sort of opportunities versus risks sort of take? So I think that's how I see the general context. What I expect to be doing in the next mandate is a lot of CMU, hopefully a lot of banking union, because that will be part of the competitiveness debate. We need to talk about sustainable finance. I mean, the 2050 date has not gone away, but we have an engineered transition to 2050, so we have to make sure that we actually make it. I always say there's no long-term trade-off between sustainability and competitiveness, but there are short-term frictions, and you have to survive to get to be sustainable. So we have to manage that transition, and that's going to be the big challenge, I think. And as I said, in digital, well, we'll see where we go.
Thanks very much for that. Koenraad, can you talk about how your financial company manages the many different mandates that you have and also works for its shareholders and customers?
Yeah, well, I think what John was highlighting in terms of challenges, of course, trickle down to what you have to do in a financial institution on a day-to-day basis. When we look into the geopolitical arena, then I do think that one of the most immediate and increasing threats are cybersecurity-related activities, because you have stately cyber attacks these days. If we just look into our statistics, we see an almost exponential increase in cyber attacks from different sides. So that's, I do think, a consequence of the many geopolitical challenges, but at home this is real and it's there. Related to Europe as such, we are also looking what is going to happen to the European Stability and Growth Pact. What will this mean to the budgets of the different countries in which we are active? Definitely when you have countries that are highly debt-ridden, and what will this mean in terms of consequences that may come from the European Commission? And of course, will this elicit reactions from financial markets or not in terms of spreads, in terms of ratings? I think when we look to Belgium, there have been some warnings already in the past, so that's something we definitely have to take into account. And from a portfolio perspective, a bond portfolio perspective, that's also relevant to manage well and to have a good day-to-day governance and framework to do this. You have, John, mentioned innovation. We do think that innovation is also a driver of diversification, definitely when you look into net fee and commission income, for instance. But of course, digitization as the hallmark of innovation also runs into some boundaries of regulation. So then you have the different digital acts in Europe. You already referred to MiCA. How do we use and develop e-money, for instance? What will be the risk-based approaches towards AI? And AI will be everywhere, because most of the mobile assistants that we will bring to the market or do bring to the market are already AI assisted in one way or another. So the relationship between innovation and regulation will be an important one. And I do think that there is a lot of legislative work done in Europe, but those legislations, they also have to stimulate innovation. I think the jury is still out there To what extent will it stimulate? To what extent will it inhibit? And definitely there is an intersection there. You need regulation. It can stimulate innovation, but sometimes it can kill innovation as well. And I refer here to the excellent book of Anu Bradford at Columbia University, Digital Empires, that really highlights the differences between innovation, regulation, digital innovation, and also the financial sector in this respect between the US, Europe, and China. Diversification is extremely important. I think no financial institution can afford not to diversify these days. And diversification can be geographic, physical, but it can also be digital. It's also across products and product lines. And of course, as KBC, we are an integrated bank insurance company. So this means that the insurance company can act as a hedge to the banking activities from time to time. So we have to exploit this diligently, but also wisely. The Green Deal is something that concerns us quite a lot. Because the Green Deal will definitely, we need it. But if I look into studies like studies by the Peterson Institute of International Economics, people like Jean-Ferry Pisani, who really shows that in the short term there are huge shocks, economic shocks to be expected in the green transition. And in the European economy, I think we have to be aware. You have John Rawls, who wrote his 80s book, The Theory of Justice. A number of Stanford researchers, scholars, translated this into fair processes, procedural justice. If we want society to go along with the Green Deal, we will have to have a fair process. How will we involve economic sectors that can be heavily affected by the Green Deal? I'm talking of the agricultural sector, I'm talking of the food sector, and this means that, for me, the jury is out there. What will be the balance between industry policy on the one hand and green policy on the other hand going forward the next 5 years? And there is a nexus there, it's called technology. We have to be very careful not to end up with stranded investments. One of the areas, for instance, where a lot of hope has been vested in terms of transition is hydrogen. I think we all start understanding the boundaries of what hydrogen can be and what it cannot be. And if Europe is going to invest 500 billion in a hydrogen transition, we have to be very much aware as to what we are investing in, definitely when we are going to mobilize the capital markets to co-invest in that type of transition. So that's a real concern that I want to highlight. And of course, it also means that looking into industry policy, not just financial sector, but in general in Europe, the productivity issue is a very important one. And this also brings us to the level of innovation and the level of entrepreneurship in our European companies. Because if we want to turn savings into innovation, into productivity, and into investments, then it means that those investments have to be productive, but that we need the innovation and the entrepreneurial attitude to do it effectively. And for a financial institution, this will be extremely important in managing our credit portfolio as well going forward.
Thanks so much. Peter, can you please give us some rates context for all of this?
Well, as you know, I've been in central banking during 20 years, so I will focus on what I think is the excessive footprint of central banks in financial markets still today. So that's the theme, 5 minutes. The first point is that it's a bit of a good news that central bank balance sheets contracted by $5 trillion since the peak. After the global financial crisis, they increased by 12 trillion, then they went down to 5 trillion. So there is still a lot remaining on the balance sheets, but has been reduced. The share of assets owned, financial assets owned by the central banks globally in the world is about 8%, 8.5% of the 450 trillion of financial assets. So it looks relatively small, but it's quite important in the markets because if you take the Eurosystem, for example, on the balance sheet of the Eurosystem central banks, you have about, still today, 30% of government bond markets on the balance sheet of central banks. It comes from 40% to 30%, but it's still very high. And it's also related to the fact that fiscal deficits have been higher. So it's not only that they've pulled back, but also the issuance has increased in between. So, and as I say, the footprint remains probably too important still today in the financial market. So we should reflect about that together. First, is it good news, bad news? But the pulling back of central banks from bond markets has decompressed the term premia only to a limited degree. It's a big question because when central banks did QE since the global financial crisis, the estimates were that term premia had been fallen by 180 basis points. So you pull back, so you get maybe a couple of tenths of reversal of the term premium, decompression of the term premium. There is a big question mark about the term premium looking forward. And that's a big unknown in the fixed income market. I have my views about this, but there are many questions about it. The second is that the central banks continue to play a key intermediation function today. If you look at the interbanking market today, it's still moribund. If you look at the concentration of central bank liquidity, it is indeed concentrated in a few big banks. Positive, if you look at the repo market today, which was really impaired during the QE expansionary period, the repo market goes much better today because the scarcity of high quality collateral has been reduced, but it's also because the issuance has increased very much, so it's better. Now, there is a very important point which is not sufficiently discussed, I think, today, I mean in general, is that QE had two functions. One was to ease the monetary policy stance, these financial conditions, but the other was to support financial stability. And think about, the flexibility of purchases of, the pandemic-related instrument of the ECB, where the ECB committed to ensure proper transmission of its monetary policy stance to all jurisdictions in Europe, which is quite a statement. In my time, we didn't say that. I mean, in all jurisdictions. And think about another example is the intervention of the Fed in March 2020 in the dash for cash, the COVID fear, where the Fed intervened by the equivalent of 8% of GDP in 2 days, buying the equivalent of 11% of outstanding US treasuries in 2 days. So is it normal? Well, special circumstances, but the weight of central banks in financial markets is really. Now, looking forward to conclude, basically, central banks have indeed communicated about the contours of their operational framework. And there are differences between the Fed, the ECB, and the Bank of England, but they all intend to reduce the central bank footprint in the financial system. But there are a number of calibration issues, how you do that. And for example, how much, and this we get closer to the previous discussion, how much central bank liquidity should you supply in the new normal? And there are many ideas about this. We go from abundant central bank liquidity in the system, with a huge excess liquidity, to what the Fed calls ample liquidity. How do you define that? And some would like to go in a system of more scarce central bank liquidity in the system. What access to central bank liquidity, under what conditions? Which counterparties? There are many counterparties, non-bank financial institutions that say, why don't we have access in Europe? The US is a different situation now since the crisis. So there are many questions about this. I think also that the communication about the future operational framework of the central banks should also reflect the ongoing reflections on the conditions for central banks to intervene in markets. What are the conditions where you think you should intervene in markets? The market maker role of last resort of central banks. That's unclear. We see it. When we see it, we know it, of course. But ex ante, how could you communicate more about the conditions under which you intervene or not? Finally, the success, and that's the message I wanted to give also to Sean and the supervisor, but the success in reducing the central bank footprints in the financial system will critically depend on the efforts undertaken by other policymakers and market participants themselves. The supply of central bank liquidity cannot be, that's the important sentence, cannot be the consequence of excess liquidity risk in the financial system. Yes, because what you hear usually is, the regulators put more constraint on commercial bank liquidity, and so the central banks see we need to supply more central bank liquidity in the system. So that looks a little bit that there is circularity in the system, because the more you toughen, the more the central banks say, maybe I should supply more central bank liquidity. This is a discussion which is not very clear. It's not an easy discussion, but it's a key discussion if you want to reduce the footprint of central bank. And the last point, of course, is that, all the work, well, the last point is indeed that fiscal policy has to be put on the sustainable path. Because when the demand for central bank liquidity is very strong, it's also because the other safe assets, government bonds, perhaps have lost some of their status in, the hierarchy of what is safe or not safe in the financial system. So the two things have to be reflected very much, sustainability and liquidity requirements in the private sector.
I very much appreciate your tying monetary transmission mechanics to the central bank environment that we're all in. We have really just a very short time left in our panel, but Sean, I would like to give you a chance to respond on the role of a central bank and what other parts of government and international authorities should do. If you have a 2-minute précis, if not, we can.
No, I mean, I'm from the Commission, so we never criticize the systems of the Commission. They're always right. I think the interesting debate is this concept of new normal. Because it is probably true that the constraints that the post-crisis regulation puts on commercial liquidity has implications for the overall availability of liquidity and the central bank's role. So I think, and we have the same discussion about post-crisis regulation, by the way. What is the new normal? We've had 15 years of fairly heavy legislation post-crisis. We should probably stop. But what is the new normal? It's certainly not pre-crisis, because this was obviously not enough, but it's clearly not what has just followed. So I think it's going to be an issue that, if anybody has the idea that the central bank can go back to what it was before the financial crisis, and that scarce liquidity is the new normal, I suspect that's not going to work. On the other hand, we probably can't continue to live in a world where the central bank is seen by some as the lender of first resort. And I think that's the problem at the moment. But as I said, I always defer to the brilliance of central bankers. But if any of them think that they can go back to the rather narrow mandate they had, focused uniquely on price inflation, even retail price inflation, I think that genie's out of the bottle, and it's not going back in, I think.
We are over time, which is a shame, because I'd love to ask you all more questions. But our 25 minutes flew by. Thank you all for coming and for listening, and we look forward to seeing you throughout the conference.